Okay, good morning. Welcome to another episode of Ridiculous. Today is November 1st, and we are continuing our efforts from yesterday to dig for more stocks. Again, this is the show where we do real-time investing, looking for letting people follow along our research process. It's for entertainment purposes only, and hopefully you get some education out of it, but it is by no means investment advice. Do your own work. We can make mistakes. We can be wrong. And everything around investing always entails some amount of risk. Okay, so where were we yesterday? What do we finish on? Yeah, yesterday we finished with looking at Saker Aviation, which was the helicopter. They operate a helipad in New York City, which is not a bad business. Actually, it seems like a pretty good business, but they are currently trying to get their contract renewed by the New York City government, the municipality. So, but the company is trading below cash. So the issue is that you need to figure out if they don't get the contract renewed, like we talked about yesterday. So this is just a quick recap. If they don't get the contract renewed, what does managers do with the cash? If they blow the cash, you don't really have protection. That's the part some people always forget, is that just because something's trading at a discount to cash doesn't mean that management will do something smart or shareholder friendly with the cash. You have to figure that out for yourself. If they are, then it acts protection. If management's going to blow the cash or do something shareholder unfriendly or take a risk that you were not prepared to take, then it's not the protection you were hoping for, your downside protection you're hoping for in your investment. Anyways, that's our spiel. So here we go. What's next on the list? CVSI. What is CVSI? So we're looking super tiny right now from our screen just to see what we can find. These guys develop, manufacture, market, and sell herbal supplements and hemp-based cannabis oil in North America. Nope. Could be a fine business, but we A, know nothing about it. B, sales have declined year over year, so diligence complete. Patriot Gold Corp. This is probably a gold miner. We don't invest in gold companies, but take a look just to make sure. Sometimes the name is misleading. Patriot Gold acquires, explores, develops natural resource properly, providing. Yep. So this is going to be a no. We'd like to look at the sales just to see what's going on. But nope, that's a no. Okay. And just because we say no doesn't mean it's a bad company. It just means that we're not smart enough to figure it out. We know that in advance, so we can pass easily. GreenPro Capital Corp. What is GreenPro Capital Consulting Services? Provides financial consulting and corporate advisory services to small medium business, primarily in Hong Kong, Malaysia, and China. Nope. Again, doesn't mean it's a bad business. It just means that we don't know anything about the consulting or advisory business services to small medium businesses in Hong Kong, Malaysia, or China. I mean, they offer what it sounds like they offer seemingly reasonable services, tax planning, bookkeeping, record management, accounting. Yeah, there's nothing wrong with what they offer. It's just, how are you sitting where you are going to figure out whether or not they are going to win in the marketplace and make more money? That's really what it comes down to. The answer is you don't know, then just move on. Your diligence, you've successfully done your due diligence. You've looked at one line, and that's all you need. Okay. Unique Logistics International. What is Unique Logistics International? Integrated Freight and Logistics. Engaged in provision of global logistics and freight forwarding services. Global logistics and freight forwarding services, allegedly with 600 employees. So how? In thousands. Okay. This looks like a reasonable business, but the stock is worthless. So something bad happened. That's not clear. Which is not clear. Net revenue, $63 million first quarter, ended August. No EBITDA. Total assets, $115 million. Stockholders' equity, $15 million. Stock is trading for $6 million. So why is this company trading for zip? Less than a penny. Apparently raised $50 million IPO. Provides third-party logistics for national goods. So they have top line but no profit. So it's not clear to us. Perhaps the balance sheet. Investor relations. Let's see what we can see on your balance sheet. Maybe the balance sheet is really screwed up. Usually when you see a stock like this, the balance sheet's really screwed up. And that would be enough to sort of answer the question. Fiscal 2023. Revenue is ended May 2023. So it's a low margin business, which I guess, well, It's logistics, right? So it's kind of like a service business. Interest expense 3.8. So they're trading for less than 1 times PE. Total assets 111 million. Total liability is 93 million. They have cash is not a lot. Most of it is goodwill, intangibles, AR, and accounts receivable. So there's a lot of money locked up in accounts receivable. This is somewhat confusing. Why? It is still unclear. Revolving credit facility, 13 million. Ah. Still trading at a substantial discount to book. So we're trying to figure out why is it so cheap? They did a SPAC deal with Edify Acquisition Corp. Maybe that's why. Was it because of the SPAC deal? They're going to take on debt to finance working capital and acquisitions. What? 10 subsidiary companies. This is confusing. Basically, the company is trading considerably below book value. Considering below book value. Yep. So we don't know. It's not clear. It is not clear. It also doesn't appear worth it. This is a basically unprofitable freight forwarding company. Why would we get involved? Unless there's something. Yes. So there's probably something. There might be something wrong. We just can't spot it, and there is nothing obviously right to actually draw us attention apart from the fact that it's trading dramatically below book. But the book value is not exactly hard money. A lot of intangibles. So We'll just pass and move on. Next, Houston Natural Resources. Waste management. Diversified energy company with oil and gas interests based in Houston, Texas. Okay, self-explanatory. Okay. Natural Resources Corp. Investor relations. Okay, so let's see. Disclosure appears very limited. Balance sheet. This is another perplexing one. So since 2021, stock has collapsed. This is like it's concerning. Yeah, this feels sketchy. So they have a growing concern note. It says, as reflected in the company financial statements, the company had income of 3.5 million, which, by the way, this market cap is 1.5 million, so we're looking super tiny, compared to net income of, okay, while the company is operating and generating revenues, the company's cash position may not be sufficient to support the company's daily operations. Management tends to raise additional funds by way of public or private offering. Management believes actions present taken to further implement its business plan, generate revenues, provide the opportunity for the company's going. Yeah. So if you're making $3.5 million a year in net income and you aren't able to finance your operations, something's wrong. Something's wrong. Because either and you're reporting cash flow, like they're reporting cash flow from operations too, not just net income, cash flow of 2.4 million. So something's wrong. And we just don't know what. There's also a legal letter with respect to current information on the. Do they even have audited financial statements? I don't think so. Yeah, we are going to pass. That is a hard pass. When you have your lawyer saying that, writing a letter to SEC or to the OTC about your financial disclosure, and your financial statements aren't audited, we're just going to pass. Don't know if it's good or bad. We just don't want to take the chance. Auditors, for all their, for everything you can say about their quality of their work, it is a reliable test. A good auditor is going to do a good job. They're not going to get everything, but it acts as a good check. What is this? Luvu. What is Luvu Brands? Designs, manufactures, and markets various consumer lifestyle products. What are consumer lifestyle products? Sensuality and intimacy products in the Liberator brand. Their products. Let's see what these guys actually make. Luvu Brands. They build themselves a innovator of brands, incubator of innovative brands. Liberator. Okay. So they have they have adult products. So they have general beanbag chairs. Very strange panel list. Bed headboards. They have I'm guessing outsourced manufacturing business. What do these actually do? Or manufacture comprehensive creation partner for mass market retailers providing best in end-to-end contract manufacturing. So it's contract manufacturer. Okay, so if you're retail, you can hire them to make products for your store that are private label Zipline. What is Zipline for kids? Love seats and playscapes. It's like kids furniture, kids houses, kids castles, kids seating for kids. Okay. So they do a bunch of generic stuff. Seems to mostly be around built on this like seating or kind of. Yes, let's look at the 10K, which is the most recent document. So they have year end of June. What do they make? Here we go, balance sheet. $1 million in cash, some receivables, mostly inventory, some PP&E. It's not. So they got about close to $3 million in debt, which is not great on a company this size. Not what you want to see ideally. Revenue. Let's see what they do. Okay, sold about $30 million worth of stuff. Gross profit $7 million. Net income 1.1. So net income doubled, but sales went up only $3 million year over year. So good. It means there's leverage if they can grow. How about their cash flow? Okay. So market cap is 6.4 million. They have net debt, but free cash flow is 500 million, 500,000. Wow. It does look like that paid down their equipment. Okay. The equipment notes that they're paying down. Okay. What did they do last year? Or a couple years ago? They've been around for a long time. So let's see what they did in 2020. Okay, so 2020, $18 million sales. 2020, 2019, $17 million sales. Okay. So far, it's looking good. They're constantly growing, which is which you know, for businesses size, you're gonna get value if they're constantly growing. If they're not growing, you're just gonna how are you gonna get money as a shareholder? 2017, 17 million. 2019, 2016, but just about the same, flat. Okay, so these guys been around for a long time, actually. 2012. Okay. 14 million in 2012, 2011, 12 million. Losing money at that point, or unprofitable, I should say. West Consulting Inc. Looks like they changed their business at some point. 2011 it's Liberator Inc. 2009 it's West Consulting Inc. So when did they change and why did they change? 2010 is still West Consulting, so I'm guessing 2011 is 2011 is Liberator Inc. On October 6, 2011, signed a definitive sale. Sailed Web Merchants Inc. Petrenko. So they sold subsidiary to an entity controlled by the president and former major shareholder of WMI. Under the company will receive 25 million shares of Liberator common stock owned by So they sold this business to an entity controlled by the president, former majority stockholder of the company that was sold. So they sold a subsidiary who the president and major owner to basically so they sold to the guy sold to himself. The company will receive 25 million in Liberator stock, and he's going to give them the stock of this Liberator company in a cash payment. So you exchange stock and Liberator. Wow, that seemed complicated and risky. Originally incorporated to provide consulting and commercial property management services. That's a okay. Well, okay. Well, aside from the good performance in 2023, this one would have a lot of questions. On an earnings basis, it looks cheap, but the products, I'm not seeing anything that's particularly spectacular. They don't look bad products, just nothing that is really maybe durable, like the bagels we looked at the other day. So, and you have these historical issues around how the company's formed, so you have to do a lot of work on that. So we will just move on for now. Nothing obvious that says why you should look at the company. No special insights into why they're going to sell more lingerie or headboards or whatever next coming year. Telecom. Nope. These guys do telecommunications, online music and video, and recycling in the Netherlands. So none of that we know anything about. Next. GD Culture Group Limited. Live stream interactive games on TikTok. Okay. In Hong Kong. Nope. Next. Universal Security Instruments. What is Universal Security Instruments? Engaged in the design, marketing, and distribution of safety and security products for use in home businesses in the United States and internationally. Alarms, batteries, carbon monoxide. So they sell alarms to wholesale distributors, chain discount television retailers, home center stores, catalog. Okay, so they sell alarm products. I get it. Looks to be growing. That's good. Okay, so let's see what the it's always concerning when I see an investor relations page where the first thing you see is their stock chart. Small companies, it's more common, but typically what you want to see is their actual filings, which actually are not available. Oh, there we go. Never mind. Just took a while to kick in. Okay. So what does their balance sheet look like? Small companies always get to check the balance sheet first. If they have too much risk, it's so easy to blow these things up. So looks like they factor the receivables, which means they get cash flow, but it will compress margins. Line of credit from the factor as well. So presumably these two amounts net off. Okay, so one of the biggest assets is the amount from the factor, which I assume is the factor in receivables, and the line of credit from the factor as well, 3.6. So they have a net asset from their factor around 2.1 million. Cash is otherwise very low. Otherwise, they have no other meaningful sort of debts other than accounts payable. So full year 2023 ended March. Sales were 720,000. Interest expense 237,000. So presumably that's interest they paid to the factor. So you're paying almost 25% of your operating income for financing. Like that's really expensive. That's really expensive. Cash flow. So they drew down inventory this year. Okay. Let's see what this factor relationship is. And I think we're done because there's not a very cash generative business. And while they do have sales, $22 million in 2023, which is good. Cash seems tough to come by, and it's paying a lot to get financing. What was it in 2020? Sales in 2020. 14.8 million. 2019, 17.5, so 18 million. 15 million. Okay. They have long history, it's good, which means they've been around for a while. And they're clearly selling millions and millions of dollars a year, but okay. 2016 sales were 13.7 million. They lost big money on that. Same thing with 2019. They're losing money 2019, 2020. 2023 looks to be the first time they made a reasonable profit. Even 2022's, they're barely breaking even. So it's possible. And let's see what the sort of recent quarter is. First 3 months of 2023, they made money considerably. Like they made 165,000 versus they'd lost $100,000 in the previous year in quarter, ended June. Six. Margins 25%. Consistent. Oh, down slightly from last year. So margins have been shrinking, but margins historically, I'm gonna bet were they lower? So gross margins were roughly the same since 2016, but now you're making money. Overhead looks like a lot. Gross profit is 6.3 million, and overhead SG&A is almost 5 million. So you are really paying to push this stuff out the door. Yeah. But it came down. So they had less SG&A in 2023. That's where most of the little bit of increase in the profit on the rise in sales, but most of it was lower SG&A. They also have trade payables to a supplier, which they've extended, which has cost them some interest rate. Which cost them some interest. Factory agreement is interest at prime plus 2. And advances are sole discretion of the factor. Okay, I think we're going to pass. So with a business like this, a couple things wrong. First of all, it's costing a lot of money to push out product, right? $6 million in profit, gross profit, and it's costing you $5 million to invest SG&A, which means it's just either really expensive to push out the door, or something. something you're not getting the pricing. Gross margins in general a little bit pretty low, like 30%. It's not inherently a problem if you can push it out the door cheap enough, but you can't. So that's problem number one. Now, there could be an opportunity, but this company's been operating that way for last 6-7 years. So unless there's a change in management, that is then therefore better at running the business, you got to assume that's going to be sort of status quo. That's problem one. Problem two is that you have this factor in there who basically controls your business with their financing. Maybe they're lenient, maybe not. Plus, you have variable rates interest. Well, interest rates are going up. It's going to be more expensive to run your business, which means your margin gets squeezed even further. So it just feels like it's not a very safe. It doesn't feel very safe. You don't have a lot of wiggle room, or maybe you don't have a lot of pricing power either. It just doesn't feel very safe. And so we'll move on. Lendway. What is Lendway? Repurchased up to 400,000 shares. Okay. Lendway. What do these guys do? Lendway provides in-store advertising solutions to consumer packaged goods manufacturers, retailers, shopper market agencies, and brokerages in the United States. It offers in-store signage solutions, provides point-of-purchase services, brand equity signs, tear pads, display marketing solutions, display solutions, and a range of fully customized temporary, semi-permanent, permanent displays. Okay. Company also operates a non-bank lending marketplace. Formerly known as Insignia Systems, changed name to Lendway in August 2023. Why did you change your name? Revenue and profitability has been volatile and maybe non-existent over time. They have a lot of cash on the books. All right, let's take a look. Okay, 6 months into June 2023, profits were 1.6 million. Big reversal from the prior year, whereas minus million. Cash working capital. Trading below book value. Doesn't look like you actually get full financial statements or full balance sheet. You just get like a summarized balance sheet data. What the hell? July 1st, 2022, we entered a $20 million settlement agreement with News Corporation, News America Marketing FSI, and News America Marketing In-Store Services. Agreement memorialized the amicable settlement of our outstanding lawsuit against News America. The settlement resulted in net proceeds before income tax of $12 million, which was recorded as a net pre-tax gain from litigation settlement in operations. So they got $12 million pre-tax in a legal settlement. Let's look at what's. So at the end of 2022, they had $14 million in cash on the books and $5 million in receivables. And total liabilities, most of which is deferred revenue. Call it X deferred revenue. Call it $5 million. So the balance sheet, shareholders' equity is $15 million. Shareholders' equity is $15 million. And they're trading for $9 million. So that's a pretty big discount. That's a pretty big discount, but 40% discount to book. And they've authorized a 400,000 repurchase agreement, or to repurchase 400,000 shares in the market, which at a current price of $5 is $2 million. So they're going to take out $2 million, spend $2 million, and how many shares are in circulation? Diluted 1.8. So 22% of the shares outstanding diluted. 22% of the shares. And how much they spend to get that? $2 million. How much of their equity? Only about 13%. So that seems like an efficient use of capital. They want to better reflect their focus on non-bank lending. In April 2023, we announced the launch of our non-bank lending business through the hiring of Randy Uglem, who has over 20 years of experience in credit and lending as Senior VP of Lending. With Randy's promotion to President and CEO on August 24th, 2023, Linway is dedicated to building a scalable non-bank lending business to purchase existing loans or originate and fund new loans, all of which will be served by collateral. As previously announced, Linway sold to an affiliate of Park Printing certain assets and liabilities relating to its business of providing store services for cash on August 3rd. Linway retained accounts receivable as well as cash and marketable securities. So they sold. Okay, this is interesting. So in addition, so who is this guy? Randy Uglem. Uglem? No idea how to pronounce that. Spent time at Ag Credit Lending Director. Credit Director is CHS. Owner of Uglum Financial. So he's a credit guy, senior credit officer. So he did agricultural loans, basic. What is CHS Inc.? He spent a bunch of time there. And Ag Credit Lending Director. CHS Inc. CHS Inc. is a Fortune. CHS is big, 38.4 billion. Fortune 500 secondary cooperative owned by United States Agriculture Cooperative. And it's publicly traded. Interesting. And they're not small. $38 billion in revenue. I have never heard of this company before. It's funny what you learn. CHS Inc. So CHS is a cooperative owned by farmers, ranchers, and co-ops across the U.S. So this guy has like farm agricultural lending experience. Lendway in August sold their affiliate business. Which was their previously called Insignia Systems. So they sold it for $3.5 million. So in addition to, assuming no significant changes, they're getting an extra $3.5 million in August. But they retained accounts receivable as well as cash equivalents, and marketable securities. Interesting. Okay. So they're getting $3.5 million. Assume that's incremental. So there's a post-closing adjustment. Find. Company received significant cash payments between July 1st and August for unexecuted programs, which the company will retain, but which will reduce the purchase price. Okay. $350,000 of transaction-related costs, previously not expensed. Also incurred $1.85 million of transaction-related severance, other separation benefits, certain termination of certain officers and employees. So the officers got nice packaged. So of that 3.5, you're not getting all of it. Maybe you're getting an extra $1 million. Okay, fine. Million change. Okay, so they're not going to have any income basically for the next few months. So they initially would tend to focus on loans secured by real estate, primarily for agricultural purposes. So this guy's basically gonna do what he's done before. So he has experience doing it. That's good. He's not going into anything else that's unfamiliar territory. Our plan is to build a portfolio of well-secured loans with a proportion of the credit risk being participated to third parties in most cases to maintain a low net loss experience and to charge fully compensatory rates and fees. Hmm. You can find his employment agreement. That's kind of awkward, no? So he could get a bonus. So he's getting paid 200 grand. Which he can get a bonus of 45%. So up to 300,000 for performance. Pay time off, 4 weeks. Okay. Termination agreement seems all standard. Taxes, miscellaneous. Okay. Does not seem crazy. Doesn't seem crazy. What we're trying to look for is any sort of information about the CEO, because basically they're betting the entire business on this guy that he can get into non-bank lending, basically farm lending, which is what he's been doing. Why that's the right approach, no idea. Two thousand seven. And he was what position? Ag Credit and Lending Director at AR T Inc. for 4 years. Air T is another publicly traded company. Okay. So here's an interesting question. Air T Inc. Investor Relations. Let's see. So for most of his career, he's doing agricultural credit lending. He did his own thing for about a year and a bit, almost 2 years, and which is also financial consulting for agriculture and loan brokerage services to agricultural producers, basically loans to farmers. He was an agricultural loan officer in 2021. He's been, most of his career at CHS is working his way up. But this Air T Inc. business is like, this doesn't seem to have anything to do with farming. But his profile says he spent 4 years there, high development managed strategy for agricultural related investments. So was it a failure to launch? Was it a failure to launch? Because if it is, then that's not good. Because what they're proposing is that they do the exact, he builds a ag business here. If you can't do it when you have a lot more resources, what are the chances you do with a lot less resources? And I'm sure there'll be lots of, well, they block, commentary about maybe bureaucracy or whatever, but so he was there. Okay, so he started there February 2019. So let's look at February 2019. Their 2019 annual reports. we can find it. 2021. Okay. So I can't find any reference for that company, which is public, of them being able to, of them having a agricultural loan business. All right. Not in their, and not in on the web or in their filings. So implication is, one is hard to develop and manage strategy for agriculture related investments. That is actually lending. Maybe it's land development. Who knows? But can't find any connection between. So we have to conclude that he might not have done much there in his 4 years, or not been able to execute it well, which is not good. Okay, so clearly this guy has a lot of experience in farm finance, farm lending. They're obviously positioning the company to do that. There is currently a discount to book, most of which is cash, which is good. And they're going to buy back stock, which is, under present circumstances, if you are trading below book and below cash book, and you think you're going to do a great job of building out a lending business, that's a reasonable use of cash. But we have no idea what this guy's track record is. We can't find any evidence of it, and it's not yet appearing in the numbers, and won't for a while. So we're happy to wait, right? And what's the thought process? Let's assume that this guy, and really just seem to bet the whole company on this one guy, or the whole strategy of this one guy. Let's assume this guy does a good job, right? And he can build a big farm lending business. Well, you're going to see that over time. And the discount to book is would not be where the big money is. Maybe make a, maybe you can get a 50% gain. Okay, not unreasonable, not terrible. In fact, it's quite good. But if you really think this guy's going to build a good farm lending business or farm related lending business, then the below book value equation at the moment should not be the biggest factor. The biggest factor should be, can this guy do it? And if they can do it, then and that can continue for a long time. They can make a nice little farm business. then you can wait to see a little bit of that. If you think of Walmart, you had after Walmart went public, so it was already a company that was producing revenue and doing well. After Walmart went public, you still could have bought within the first 5 or 10 years and made, you know, god ungodly multiples of your money. So in this one, there's no compulsion to rush in. Doesn't feel like there's compulsion to rush in. And arguably, fine, buying back stock is good, but if if you have lots of opportunity for profitable, what it means is there's less opportunity for profitable investment because of that. You're still spending $2 million in cash. So if you can put that $2 million to work building business, you know, maybe a better idea. Okay. Lenway seems like an interesting situation that we're fine to hang out and wait and watch and see how that story develops. No need to rush. No need to rush in. Destiny Media. Software technology. Those technologies that enable the distribution of digital media files in a streaming or digital download format over the internet. It offers Play MPE that distributes promotional content, including broadcast audio quality. Okay. So they are a software streamer? Software, what do they do? No. Financials look mediocre, and it's technology that I don't really get. So we'll pass. Marine Petroleum Trust. Marine Petroleum Trust. 13% dividend yield. Midstream oil and gas. The operator royalty trust is overriding royalty interest in central and western areas of Gulf of Mexico, off coast of Louisiana, Texas, Marine. Okay, so oil and gas royalties. So it's oil and gas royalties. The stock is down about 50% last year. Okay. What is their fiscal year? Yeah, they just paid everything as dividends, basically. So everything's distributions. As long as, I guess, as oil and gas prices stay high, distributions are wonderful. So net quantities sold in terms of barrels. It's up dramatically, obviously. 2021, 9,000, 16,000, and 17,000. I'm assuming it's thousands. About 200,000 gross acres, mostly in Louisiana and Texas. But it's in the water, so it's marine acreage. They have fractional interest. Yeah, and it's all been driven by the price of oil. Average price in 2021, $40. 2022, $78. 2023, $90. Yeah, so as they've obviously, as oil skyrocketed, so is their royalties. So is the royalty stream. So it's basically bet on the price of oil. To some extent, the production, obviously, of course, but so it's $1 million in cash on the books, and then it's all price oil. So what's the advantage? It's a bet on price oil, which we know nothing about and can't do. So we'll skip it. Okay. Medical care technologies. Development stage company. Opening, operating children's health wellness centers in China. Okay. Diligence complete. Next. Strong Global Entertainment Inc. Computer hardware. Manufactures, distributes projection screens. Customized screen support in North America, South America, Asia, internationally. Distributes digital cinema equipment, provides technical support to the entertainment industry. Offers Eclipse curvilinear screens. Okay. Other applications. So they make and sell screens. Are they good at it? Profits appear volatile. Not much in the way of free cash flow. Stronghold. They're only showing, is this a new company? 2 entries. Wow, they got a lot of debt. Nope. Pass. Nope. Pass. A lot of debt, a lot of cash flow. And I don't know anything about the screens business. We will take another approach. Financial services. Reinsurance, merchant banking, asset management. Okay. They offer specialty property P&C insurance. Special also operates a SPAC that provides various strategic administrative rights support to newly formed SPACs for a monthly fee. So they operate a SPAC that does services for SPACs. That alone seems like it would disqualify them as a good company. Yeah. And the financials are all screwed up. Nope. Next. So it's trading dramatically. Let's actually take a look at the financials. But it appears to be trading dramatically below book. But an insurance company, unless you're confident that this company has good track record and good book value, that's a bad sign. It means you might be sitting on a lot of bad risk. As of December 2022, Fundamental Global GP, a private partnership focused on long-term strategic holdings and its affiliated entities, collectively beneficially owned 60% of common stock. D. Kyle Surminara serves as the founder. Okay, so who is Fundamental? And Joe Moglia. Who are these guys? Fundamental Global. They reincorporated on December 22nd, December 2022. They sold the insurance business to FedNat Holding Company. Strategy evolves to focus on opportunistic collateralized and loss-capped reinsurance with capital allocation and working banking activities with asymmetric risk reward. So the guys seem legit. Fundamental Global is a private partnership focused on long-term strategic holdings, co-founded by former T. Rowe Price, Point72, and Tiger Club portfolio manager Kyle Seminara, and former chairman and CEO of TD Ameritrade, Joe Moglia. So these are serious guys. Question is, why the hell are they taking over a $13 million piece of nothing at 60% in the 8% cumulative preferred stock? In Q4 2020, we sold a total of 750,000 shares of common stock at a price of $4 for net proceeds of $2.5 million. Completed a rights offering as well. They sold more stock at $1.58 per share in June 2022. So the price has tanked. Jesus, 2021, $9. FG Financial Group, Inc., Merchant Bank Company Merger F. Merchant Banking Platform Company FG Merger Corp has completed business combination with iCore Connect, a market-leading cloud-based software and technology focused on increasing workflow productivity and customer profitability through its enterprise healthcare workflow platform. FG Financial Group CEO Larry Sweats. All right. I think this looks interesting enough for a closer look. Let's look at the most recent quarter. Let's look at the most recent quarter. Ended June. And premium loss and loss adjustment expenses. So it has about, I see. Okay. What does their income statement look like? Premiums and investment income. Net losses and loss adjustment expenses. Right. G&A. So they are losing money. Or, yeah, they're losing money. It's costing money to run this thing. And they're paying dividends on the preferreds, but they're issuing common. That's not good. They paid almost $900,000 in dividends to preferreds, but they issued $1.3 million in common. That's really bad. That's really bad. FG Group Holdings, FG Financial Group. So they also have a publicly traded holding company. Which is also kind of more abundant in Okay. There's definitely something here. The question is, are common stockholders going to be the beneficiary? There's something here. Like this FG Financial Group is trading for $14 million market cap. And it has, at June, $37 million of equity, most of which is in assets, like equity securities. They have other investments, don't know how liquid that is, reinsurance balances. Now, if they're going to take some bad reinsurance losses, that's really bad. So you don't want to do that. There's this. They're raising stock to pay out the preferred dividends, which, that alone should be enough to kill it. Looks like there's a lot of interrelated holdings as well. All right, that's where we're going to cut it today. We got to think about this one. It feels like there might be an opportunity, but you'd have to dig through a lot of corporate action, which is, and you'd also have to sort of work out whether or not you as a common shareholder are going to ultimately benefit. If you're not going to, if it's too much risk to the common, and that's the position you're taking, right? So you might have a very impressive resume of potential partners, but if those potential partners get all the profits and the gains, then you're kind of out of luck. So we'll think about this one for now, and we will see you guys tomorrow. Have a good one.